All right. Okay. Good afternoon, guys. So today we're going to cover another couple of swaps topics. Okay, or swap products. Okay. Um, so when you talk about yesterday we talked about interest rate swaps and the interest rate swap where basically the underlier is a interest rate. Okay. And so here's the thing, right? When we talk about derivatives and swaps, right? Your underlying assets can be extremely different. Okay, when I say extremely different means it can be various different things. Okay, so it can be financial instruments, commodities. It can be non-financial instruments like weather, for example. Okay, or a disaster. You can even do disaster trading. There is a concept like that. Okay, so you have a lot of different types of underlying assets in terms of swaps and derivatives. Okay, swaps and derivatives. Okay. All right. Now, let's get to the first one today, which we call as CDS. Okay. Now, CDS stands for Credit Default Swap. Okay. Now, let's break down the word. Let me type it up. So the first one that we're going to talk about is credit default swaps. Okay, now let's break down these three words. What can somebody explain to me? And don't get and I know some of you might know what this whole thing is, but let's understand it word by word. Okay, so when we talk about credit, what do we mean by that? Okay, and try and relate that to, and I'll give you a hint. Relate that to a financial instrument. Okay, so when we talk about credit, right? What are we talking about? What type of financial instrument? Come on, try. What? Borrow money. Okay. Uh, what else? Okay. So borrowed money is what type of financial instrument then? So we're talking about financial instruments, right? So, all right, there we go. So it's a debt instrument or a fixed income. So when we're talking about credit default swaps, okay, it is fixed income. Now, what does the word default generally mean? What does default mean? Okay. All right, it's a failure to repay whatever it is, not able to pay. Okay, fine. So we'll use the, default. We'll use the term. Well, okay, let's use the word fail to pay. Okay. Now, when we talk about swaps, it's an exchange. Okay. Now, those of you who don't know CDS, right? So by breaking down these three words, what do you think credit default swaps is? What do you think it means? So credit is a fixed income, default is fail to pay, and a swap is exchange. What do you guys think? Not exchange of credit. What else? Okay. Now let me put this question back to you guys. Is that so? When we look at securities, right? Um, we exchange again comparing equity with fixed income. What is the safest when you talk about equity versus fixed income? Which one is the safest? Yeah, okay, fixed income. That's one. Okay. Now, what is the risk? So now when you talk about equity, what is the risk that you have? What's the risk in equity? So if you invested 10,000 rupees in a particular company, what is the risk in the equity? Vibor, hang on, we'll come to that, but we'll come to it. When we talk about equity, what's the risk? Okay, so market fluctuation. Okay, so essentially, when you talk about the risk in equity, is you bought shares of a company at 300 rupees, and 1 year later, it's trading at 50 paise. That's the problem with equity, right? And that's capital depreciation, like what Weber has mentioned. Okay, now that is the biggest risk. And now that is the biggest risk that you actually incur when you are holding on to equity. Okay, that's the first thing. And second, because you have ownership in the company, right? The You have willingly taken on that risk. Okay, you've willingly taken on that risk, so that even if you lose the money, right, you know that you're okay with it, right? So that's the issue with equity. Okay, capital depreciation, and you know that if that happens, you will not get your money back. Fine. Now my next question to you guys is, what is the risk in fixed income securities? What is the major risk in fixed income securities? Okay, what else? All right, so we have a couple of different risks, right? So first is we have interest rate risk, okay, and the relationship between interest rates and bond prices. Inflation is also a risk, okay. Credit rating, liquidity risk, all of that. And I think a few of you mentioned is that, what if the company writes off its debt, right? That is a big concern in fixed income securities, because when you buy a fixed income security, right, what you're essentially doing is you are lending your money to a company, and the company has promised to pay you back in due course. Let's say in a 10-year bond, they'll pay it back to you in 10 years. And during that 10 years, what happens is that you get an interest payment. Okay. So now let's bring all of this together. So when you talk about a credit default swap, what this means is that it's an agreement to buy protection against a credit event. So don't worry, we'll talk about what a credit event is on a fixed income underlier. See, only on a fixed income security can a company default. Basically, they can default in paying the interest or paying the principal. That's what they can default on, right? Now, interest rates, inflation, they don't really have a control over that. But as a company, the biggest risk for you as an investor is, what if they don't pay you back? Okay, so that is why you enter into a credit default swap contract to protect yourself against the possibility of a default. Again, that's what we mean by a credit event. Okay, is this clear with everyone? So we've broken up the terms credit default swaps. Okay, and credit means fixed income, default means fail to pay. Now in this case, what is that fail to pay? Coupons and what is that, principal, right? Coupons and principal, right? That's what they're going to fail to pay, and you're going to exchange that risk with somebody else in the market. Now let me be clear, is that the underlying asset is a fixed income security, so that includes bonds, MBS, ABS, etc. Okay, so it cannot. So a lot of times students tell me commodities, and my BP goes up for that. So a lot of students say equity, then my what do you call it? BP, then blood pressure goes up, then I get heart palpitations, and yeah, my pulse goes up. Yeah, um, and I come very close to having a heart attack or a stroke. I swear, right? So please be clear. Yeah, anxiety. Trust me. So I don't know if you guys can see my head clearly, but there's a lot of gray hair, and each gray hair is attributed to a student. Okay, it's attributed to a student, and don't worry, you will also give me some. Okay, that is a given, right? As a teacher, I realized that. Yeah. So before I joined Imarticus, right, I had a bit of gray hair. I look very okay with it, but now it's become completely gray, almost. So I still have a little bit this thing, but it's become completely gray. So please don't say the wrong stuff, right? So if I ask you what is an underlying asset on a CDS, you have to say it's a fixed income security, not equity, not commodities, not interest rates. I don't know. Yeah, none of that. Okay. Yeah. So it's always going to be a fixed income security. Yeah. All right. Are we clear in this? Okay, so the underlying asset here is the underlying asset on a CDS is going to be a fixed income security, either a bond or mortgage-backed security or asset-backed securities. It is not going to be commodity, equity, interest rates, or anything else. Okay, it's always going to be a fixed income security. Okay, all right, take a minute and write this down, and then we'll move on to the next bit. No problem. Let me know when you guys are done writing, and then we'll discuss this further. Okay, one more minute. Okay, cool. Now let's look at how a CDS works. Okay, So now, let's say talk. Let's say there's an investor, okay, um, and they want to yeah, they want to invest, okay, let's say $10,000 in company ABC bonds, okay. Now, what happens is that now company ABC, they're going to issue a bond at, let's say, face value $10,000. Okay. Now, what will this bond that they're issuing, right? What is it going to give? Now, let's say, okay, issue a bond face value 10,000 for 10 years with a 10% coupon rate. Okay. So, what is this bond going to give the investor? Hmm, right? So, this bond is going to generate $1,000 in coupon payments for the next 10 years. Correct? For the next 10 years, this is what's going to happen. Okay. Now, this can be, what do you call it? Quarterly payment, half yearly payment, whatever it is, right? Quarterly payment, half yearly payment, whatever it is, or a yearly payment, it's going to all come out to $1,000 per year. Okay. Now, what should the investor do to get this bond is the question. Investor has to pay $10,000 to company ABC, right? And what will company ABC do in return? Company ABC in return will pay uh, pay $1,000 for the next 10 years. Yes, we agree that this is how a bond works, right? This is how a bond works, right? So it can be a government bond, it can be a junk bond, it can be a corporate bond, whatever it is. This is the logic. So you are the investor, I'm the company. You pay me $10,000. I will give you the bond. Okay, I'll sell the bond to you, and as long as you hold on to the bond, I'm going to pay you $1,000 in coupon for as long as you hold it. So if you, let's assume that you hold it for the next 10 years, so every year you're going to get $1,000. Okay. Now let's make an assumption here. Assumption is that company ABC bonds are junk rated. Okay. Now, if a bond is junk rated, right? Uh, why would you even invest in it? What would be the reason? What would be the reason for it? Okay. Uh, High risk, but commensurated with high returns, potential in a company, interest rate is size issued at discount, high interest payment. Okay, so basically your returns are better, right? Now, do we know? And now, are junk bonds a bad thing? Are junk bonds bad? Yeah, they're risky, but are they bad? Are they something bad or negative? Okay, it's not necessarily, right? Now, see, when a company is issuing a bond and it's a junk bond, right? Maybe it doesn't have the credit worthiness, right? It doesn't have the credit worthiness, and that's why the credit rating is low, or those kind of factors, right? So, but it has a lot of potential for growth. Okay, and I think we discussed this in fixed income, right? Is that uh, for many years, up to I think 2016 or even 2018, right? Government of India bonds were considered as junk rated. I think we had discussed this, right? Government of India bonds were junk rated bonds up till 2018. Okay, then they moved to investment grade, and then recently again it's been downgraded, but just above junk bonds. Okay, so it's not only companies, okay, but also countries will have a credit rating attached to it, and for many years, right? For many years, the Government of India bonds were actually junk rated companies. Okay, all right. Now, like what I mentioned before, right? So I'm an investor. I'm willing to take this risk, and I've invested $10,000. Now, it's just an example, right? Now, imagine put $100,000, $1 million, $10 million, $100 million. Then the investment value goes up. Okay. Now, if you are the investor, right? What are you worried about? What are you worried about is whether you will get your principal back and your coupon back. That's what you as an investor, yeah, exactly, default, right? So that is what you're worried about, whether you're going to get your coupon or principal back. So what are you going to do to hedge yourself is you are going to come to me, and I'm an investment bank. All right. Now, what we do is that as an investment bank, okay, you come to me as an investor and say that, okay, hi Rakshit, see, I've invested X amount of money with company ABC. Now they are a good company, but I'm afraid, I think maybe in the foreseeable future, maybe they might default, and I want to protect myself against that. So that is why I want to enter into a CDS contract. Okay. So then I as a investment bank, right, say no problem. So in order to enter into CDS contract, you as an investor will pay a premium. Okay. And I as an investment bank, right, will pay you an agreed amount. Okay. We'll pay you an agreed amount. Okay. Now we'll talk more about when it happens. So, when will you actually use a CDS contract? But did you guys uh, get the point of why they are entering into a CDS contract? Because they are afraid that the coupon or the principal might not be paid to them in case the company moves towards default. Okay, is this clear with everyone? Yes, no?
So, what investment banks takes from investor?
Sorry?
So, what investment banks takes from the investor to enter into the contract?
Investment bank is taking the premium, right? They're paying the premium from the investor. Premium is being paid to the investment bank. Okay, exactly, Biswajit. Very good. It's like insurance. Okay, take a minute, write this down, and then we'll go a little bit more in depth on this. Okay, sure, sure. I'll repeat one more time. Okay, so like we discussed, right? So an investor buys the bond from company ABC. Now, in order to buy this bond, they are going to pay $10,000 to company ABC, and company ABC will, in return, pay $1,000 for the next 10 years, which is the coupon. Okay. Now, the investor is worried that the company ABC might default. Okay, now default in what? In terms of the coupon and principal. Okay, now if the company defaults, right, then obviously the investor is going to lose all their money. Okay, now you got to understand one thing, right? Now, a lot of you will say, but anyway, since he's a bond holder, he will get his money back when the company finally winds up and all the assets are sold off. But that's going to take a long time. It's going to take a couple of months or couple of years, and nobody's going to wait for that long, for the money to uh, actually come. Okay, so that is why, to hedge themselves against the default risk, okay, the investor will enter into a credit default swap contract with an investment bank, and the investment bank will ask the investor or the client to pay a premium, okay, to pay a premium, and the investment bank will pay an agreed amount. So we'll talk more about the premium and the agreed amount, but this is essentially what is a CDS. Okay, now, like Biswajit had mentioned, right? CDS CDS acts like a insurance policy. Okay, all right. Let me know when you guys are done, and we'll move on. Okay, one more minute and then we'll start. Okay, cool. Majority are done. All right. Now let's talk about when will the CDS contract actually be used. Okay. Now, what do I mean by this is that, so when you spoke about options, right? You will exercise an option contract based on whether it is profitable for you or not, right? So you can take that decision. Okay. Now, when you talk about a CDS, right? There are only three to four specific reasons why of when you can exercise the CDS contract. Okay, it will not be anytime you want. Okay, but rather when something specifically happens. Okay, so we call this as a credit event. Okay, we call this as a credit event, right? Now, what are these credit events? The three major ones, right? Is first one is what we call as the company going bankrupt. All right, so company ABC, let's say, files for bankruptcy. That means that there's a high probability that you will not get your money back. Okay. Second one is what we call as moratorium. Okay. Now, moratorium. Have you guys heard of it? I mean, recently we have heard of this word because of the COVID pandemic. But basically, when we talk about moratorium, right? It is a delay in the payment. Yeah, it's a delay in the payment. And then finally, we have what we call as restructuring. So when the company decides to restructure their balance sheet and they can decide to write off their debt. Okay, it is possible that a company can write off a bond, and there's nothing much that can be done about it. Okay, all right. So these are the three major credit events. Okay. So if I ask you, when will a investor exercise their CDS contracts? You're going to say only in three instances: bankruptcy, moratorium, and restructuring. So bankruptcy again, company going bankrupt or basically insolvent. Moratorium is when they decide to delay the coupon payment or the principal. Okay, so both is possible. Okay, either one of them is possible, or one like principal can be delayed or coupon can be paid, or both can be delayed. Okay, and finally restructuring. Okay, restructuring. Okay, is this clear with everyone? Take a minute and write this down, and then we'll move on to a little bit more about premium and what will the investment bank pay. Okay, no worries. Okay, restructuring. So you guys would have heard of companies restructuring, right? Or just general term restructuring. Okay. Now, when we talk about restructuring, right, basically the company is going to restructure their capital. Okay, that could be one of the things that they can restructure their capital, and in that process, right, they can choose to write off its debt. Okay, and so for example, yesterday we talked about SBI, right, writing off 66,000 crores in bad debt, right? Now imagine that 66,000 crores was a bond that SBI issued. Now what could end up happening is that if that, and let's say you were the unfortunate bondholder, that means SBI could have written off this bond and you would not get your money. So that's the idea of restructuring, where the company decides to restructure their capital, and in that process, the debt could be written off. Is that clear with everyone? Okay, let me know when you're done and we'll move on. Yeah, it can be done anytime. Okay, board resolution, shareholder. But yeah, but once they get that, they can do it, right? Okay. Okay. Now let's talk about how is the premium decided on a CDS contract. Okay, how is premium decided on a CDS contract? Okay. Now the premium is decided through what we call as a survival rate and a recovery rate. Okay, so let me write this. Okay, so for example, okay, so survival rate, recovery rate, and premium. Okay, now let's say that the survival rate of a company is 30%. Okay, now is that survival rate high or is it low? Low. What about the others? Is it low only? Okay. So you guys have to think about this the other way. So when we say survival rate, right, what we mean is that what is the probability of the company defaulting? Okay. Now, if we say the survival rate is 30%, okay, what does that mean? So that the company has only a 30% chance of surviving in the market. So that is why if the number is low, the survival rate is high. Okay. And what will be the recovery rate will be 70%. Okay. Sorry, wrong. Survival rate is low. Okay. And the recovery rate will be high. Okay. Sorry. All right. So survival rate is low. That means the probability of the company defaulting is very high. So they, in a sense, when I say low, right? Like, okay, think about it this way. Okay. Let's say if somebody who's 70 years old, what is their probability of them falling sick and something bad happening to them? It's pretty high, right? So that's what we mean by the survival rate is low. Okay, and because the survival rate is low, the recovery is going to be high, and the premium that they're going to pay is also high. All right. Now, how I want you guys to think about this is that imagine there are two people buying an insurance policy. One is, let's say, a 70-year-old man, and another one is a 21-year-old. Okay. Now, for the 70-year-old, will the premiums be very low or will the premium be very high? Exactly. The premium will be very high. Okay. Now, because they're paying a higher premium, right? The recovery rate or the sum assured will be much higher. Okay. Now, when we talk about the other side, right? So, if we say the survival rate is 70%, what we mean by this is that the survival rate is high. Okay, survival rate is high. That means the probability of the company defaulting is low. Okay, so the words are a little confusing at times, but this is how it is. Okay, so when I say survival rate is 70%, right? That means the probability that the company will default is low. That means they're not going to default anytime soon. Okay, so that means what the recovery rate will be only 30%. So they're only going to recover a less amount. Okay, and the premium that they pay will be less. Okay, now let's and how I want you guys to understand this, right? Okay, think of two people who want to buy an insurance policy, a 70-year-old and a 21-year-old. Okay, so for a 70-year-old, because the risk is high, okay, risk is high, they have to pay a high premium. Okay, and for the 21-year-old, the risk is low, and they have to pay a low premium. Okay, that's how I want you guys to think about this. Okay, now what does this mean in terms of the CDS, right? So if you talk about the first instance, right, the recovery rate, okay, so when I say 70%, right, it means 70% into $10,000. So they are going to, investor will recover $7,000. Okay, and in the second instance, recovery rate, okay, is, let's say, 30%. Okay, so that's into $10,000. Investor will recover $3,000. Okay, so what we say by this, right? Survival rate and recovery rate have a inverse relationship. So the lower the survival rate, the higher the recovery rate and higher the premium. Okay, so survival rate, recovery rate, indirect relationship, recovery rate and premium, direct relationship. Okay, and if survival rate is 70%, recovery rate will be 30%, so indirect, and the recovery rate and premium will also have a direct relationship. Okay, so indirect, direct. So survival rate, recovery rate, indirect relationship, recovery rate and premium, direct relationship, survival rate and premium, indirect relationship. Okay, is this clear with everyone? Okay, all right, take a minute and write this down, then we'll move on. Okay, and also I've just defined what is survival rate and recovery rate and premium. Okay, so write all of this down and let me know when you're done. Okay, one more minute. Okay, everybody's done. Okay, now if you look at this, right, what did we talk about? Yeah, exactly, Saurabh. Yeah. So what did we just talk about, right? So let's start at the beginning. Okay. So we talked about what is a CDS? What's the underlying asset of a CDS? Then we constructed this example of what an investor buying junk rated bonds, okay, and then going to an investment bank to protect themselves, okay. And when will they use that CDS contract? When there's a bankruptcy, the company goes bankrupt, moratorium, or restructuring. And the premium is decided, okay, based on the survival rate and recovery rate. And survival rate and recovery rate have an inverse relationship, and recovery rate and premium have a direct relationship, okay, and survival rate and premium have an indirect relationship, okay. All right. And then same thing. So survive the probability that the company might default in the market, and the amount you will recover in case the company defaults. And premium is the amount you pay to enter into the contract. Okay. Now there are different types of CDS. Okay. So the first one is what we call as a single CDS. Okay. Now a single CDS considers the debt obligation of only one company as its reference obligation. Now, the example that we just talked about, right? That's a single CDS where the investor is holding on to only one company's bond. Okay, that's what we mean by single CDS. And a basket CDS, right, is where the investor holds on to multiple bonds of different companies or same company that have issued different bonds. Okay, so basket CDS is a basket, many different types of bonds. And finally, naked CDS. Okay, it does not consider the debt obligation of any company. So in this case, they're not holding on to any of the bonds. Okay, so the first two, like I mentioned here, right, it is used for hedging. Okay, and the third one is used for speculation. So now the naked series might seem a little weird, but because you it's basically this, right? You are so you don't necessarily have to own an asset in order for you to speculate on it, right? So the entire futures market works on the speculation perspective. So if I think that this company is going to default, okay, then I can enter into a CDS contract with them, not with the company, obviously, with the investment bank, saying that they are going to default on their debt obligation sometime in the future. Now, until then, I'll keep paying a premium as usual. And in case they do default, right, on the bond that I said that they will default on, that will be the recovery rate that they pay me. Okay. So are the different types of CDS: single CDS, basket, and naked. So the first two are speculation, and sorry, first two are hedging, and the third one is speculation. Is this clear with everyone? Okay. Which part, Dipesh? What is confusing? Which part are you not understanding? Ah, okay. All right. So types of CDS. In a single CDS, the investor is holding on to the bond of only one company. In basket CDS, the investor is holding on to multiple bonds of maybe the same company or of different companies. It's a basket of fixed income securities. Okay, and they can take a CDS contract on that. And a naked CDS is when you don't own the underlying asset. You don't own the underlying asset. You're just speculating that the company might default. Okay, take a minute and write this down, and then we'll move on to the next type of swap. There's no example as such, but rather the idea is that you enter into a serious contract where you don't own the underlying asset. Yeah. So when you talk about futures market, right? When you trade futures, right? Most of the market participants don't own the underlying asset. Okay. So again, let me be clear. So you're a hedger when you own the underlying asset. When you don't own the underlying asset, you're a speculator. Huh. So that's yeah. So what Saurabh was saying makes sense. Okay. You can speculate whether Yes Bank will default on their bonds or not, and you have to specify which type of bond that they've issued that they might default on. And if they do, you will make your money. Otherwise, you'll not. You'll not make your money. So Vibur, it's largely a choice in futures. It is a choice whether you want to exercise the futures contract to take delivery of the underlying asset, or you can just take the cash delivery. Now 95-99% of futures market is all speculative in nature, so that is why they largely will just take the money rather than own the underlying asset. Yeah, so it is a choice. But let me also be clear with one thing is that uh, when they trade crude oil, okay, in crude oil, you have to take the physical delivery. But otherwise, in most of the other this thing, right, where equity and others are the underlying asset, then you can just take the cash. Yeah, so sort of, yeah. See, for example, right, if you bought, let's say, shares of Bharti Airtel, you're speculating that the price might go up. Okay, so so if the price goes up, you make money, right? So investors are largely speculators. Okay, now it's difficult to make money in the financial markets, right? It has a lot of challenges and you have to really work hard, but once you are able to kind of get a fair understanding, right, you can make some decent amount of money in the market. Okay, everybody done writing? Okay, so now this is it with CDS. Okay, Now we'll move on to the next type of swap, which we call as the FX swap, okay, or foreign exchange swap. Without holding the asset insured by the CDS. Exactly, Deepesh. So without holding the underlying asset, you can buy a CDS contract. Okay, I know it sounds a little strange, but that's how the market is structured. Okay, see, let me tell you one thing about OTC derivatives, right? Whatever you can imagine can happen, and whatever you don't imagine also can happen. Okay, so both is completely plausible with the OTC derivative market. Okay, yeah, all right. So now let's move on to the next one, which is FX swaps. Okay, so when we talk about FX swaps, right, what do we mean by that is it's a simultaneous purchase and sale of one currency for another with the same trade date and different settlement dates. Okay, FX swap is a simultaneous purchase and sale of one currency for another with the same trade and different settlement dates. Okay, now do not confuse a normal foreign exchange transaction. In normal FX transaction, what happens? I pay you USD, you pay me Euro. Okay. But in an FX swap, right, what you're doing is that you're agreeing to the exchange rate on a certain day, which is your trade date, but you're settling those currencies on a different date. Okay, is this clear? So what is trade date essentially? Anybody know? What is trade date? No, guys are not aware of what is the term trade date. Okay, order date. Okay. Okay. Not exactly. Yeah, order date, but so when you say trade date, what do you mean by that? So let's say so okay, let me just I think you guys are a little confused on it is when you talk about a trade date, right? It's the day that you enter into a contract. Okay. Yeah, when you place the order. Now, see, it's not necessary that when you place an order, it'll get executed, but essentially, when you have entered into a contract, right, that is trade date. Okay, and settlement date is the day you settle a contract. So, when we talk about an FX swap, what you're actually doing is that you are agreeing for the exchange rates on a trade date. Let's say what is today's date? 7th or something, right? Yeah, 7th June 7th June, right? Yeah. So if we agree to the exchange rate as of today, we can settle the FX deal either today or sometime in the future. So that's what we mean by an FX swap. Now, FX swap is one of those few types of swaps where the notional will be exchanged. Okay, notional will be exchanged as well. See, so far with the others that we spoke about, right? The notional will not be exchanged, but in an FX swap, it will be. Okay, is this clear with everyone? What is an FX swap? Okay, take a minute, write this down. No, it does not. So what? Vibor, yeah. So sort of, yeah. It is like sort of like arbitrage. Okay. So what do we mean by notional being exchanged, right? So if you and I enter into an FX swap for USD Euro, where let's say USD, I want to sell 100 million euro and I want to buy 98 million euro from you. Okay, is that I will sell you I will give you the dollar and you'll give me the euro. That's the notional value. Good question, Annette. No, they're not. FX swap is something else, and it's not currency swap. It's called as cross currency swap. So cross currency swap is completely different, and FX swap is completely different. Everybody done? Okay. Now, when we talk about an FX deal, right? What it means is there are different what do you call it? Transaction day what do you call it, names for a FX deal. Okay, there are different names for a FX deal. Is this clear with everyone? Okay, now what do I mean by this is that we have there the terminologies are cash deal, tom deal, spot deal, and a forward deal. Okay, so let me show you what that means. Okay, one second. Second. Okay, so let's look at this. Okay. So when you talk about an FX swap, right, there are different terminologies that are used for it. Okay. So we have something known as a cash deal, Tom, Tom deal, spot deal, and a forward deal. Now, what do we mean by a cash deal is that when the trade date and the settlement date is the same. Okay, so if you and I enter into an FX swap contract, okay, with today's trade date, okay, and we say we want to do a cash deal, so we'll also settle the transaction today. So same day settlement. And we talk about Tom deal, right? What that means is that means tomorrow. Okay, that means tomorrow. Okay, that means you and I enter into the contract today, so we agree the exchange rate today, but we settle the transaction tomorrow. So Tom means tomorrow, and spot means 2 days from now. Okay, so if you and I enter into a contract with today's trade date, okay, the settlement date will be 2 days from now. Okay, now anything greater than 2 days is known as a forward contract. Okay, it's a forward deal. Okay, now when you talk about an FX swap, what this means is that, yeah, FX swap is a combination of the above deals. Okay, Now, what do I mean by combination is that you and I, so we do two deals, two FX deals, okay? So we can do one cash deal and one Tom deal, or cash and spot, cash and forward, or Tom spot, Tom forward, or spot plus forward, okay? So we can do all of this. Now let me show you guys an example, right? So let's say that we do the first FX deal is USD Euro, okay? The second FX deal is, let's say, USD JPY. Okay, so if we say this is a cash deal, what do we mean by this is that the trade date and settlement date will be the same. That means you and I enter into this contract today and we settle the contract. So what do I mean by settle is that I'll pay you and you'll pay me. Okay, now if it is a Tom deal, okay, that means it'll settle tomorrow. Okay, that means we'll agree to the exchange rate today, all right, and we will pay each other tomorrow. No, no, it's not. Second leg is not the reverse transaction per se. It's two deals. So one is USD Euro and one is USD JPY. Okay. So these are two FX transactions. But why we are entering it today is that maybe the exchange rates for both these currencies are favorable today for both of us, but we want to take the delivery of it sometime in the future. Okay. So that's what we mean by this FX deal. It's a combination of cash, Tom, spot, and forward. Okay. So for example, like it's mentioned here, right? So we can do a cash plus cash deal. Okay, we can do a cash plus Tom, cash plus spot, or cash plus forward. So any one, two, three, four combinations of this, right, is your FX swap. Okay, is this clear with everyone? So it's not necessarily a reverse of the transaction, Saurabh, but rather it can be two FX deals, two separate deals that you and I enter into, where I want one, like I want USD Euro, I want to do USD Euro, and also want to do USD JPY. We can enter into the contract today, and we can settle in different days. Okay, I'll repeat it. But first, write all of this down. Okay, so that once you write it down, right, it'll become clear, and then I'll explain it again. And let me know when you're done. Sure, Saurabh. I'll do that. Okay, everybody done writing? Okay. So, Saurabh, I'll give you more of a practical thing. So, I'm pretty sure whatever you have read, right? That's correct. Okay. I'm not going to, uh, confuse you with what you've studied. So, whatever you studied, that's also correct. But I'll tell you guys what do I mean by this. Okay. So, I'll give you both sides to it. Okay. Um, Now, let's say that. Um, let's talk about just one currency. Okay, so let's say USD euro. Okay, now I want to buy. Okay, I want to buy USD. Okay, and I want to sell euro. Okay, now what happens is that now let's say hang on, let me find the USD euro rate. Anybody have an idea USD euro rate? Hang on. Okay, $1 is 0.89 euros. Okay, so it says $1 equals euro 0.89. Okay, 0.89. So when we talk about this, right, with the FX swap, okay, what do we mean by this? Hang on. Is that now let's say that when we say $1 equals 8.89 euros, what do we mean by this? So if I want to buy $1, if I want to buy $1, how many euros will I sell? Is that correct? So imagine this. So I give you $1. Okay, if I want, rather, I have euro, you have dollar. Okay, so if I want to buy dollar from you, I have to give you 0.89 euros and you'll give me $1, right? So now let's understand this, right? Now let's say that you and I get into a USD euro deal, okay, where let's say the rate is 0.8912 and 0.08915. Okay, random this thing. Okay, now what's happening is that when we talk about an FX swap, is that let's say that I want to buy 100. Let's use, okay, let's say $1 million. I want to buy $1 million. So how many euros will I sell? Can anyone tell me? What will it be, guys? Come on. Only two. What about the others? Do you guys get my question? So if I want to buy, so if you guys remember this in FX, right? So USD is your base currency, Euro is your quoted, 8912 is your bid price, and 8915 is your ask price. Okay, so bid and ask. Okay, bid is buy, ask is so. And what did we say? You have to look at what's happening to the base currency, right? So if I want to buy $1 million, what rate will I use? Will I use 8912 or 8915? I think some of you guys forgot FX, I have a feeling. No, see guys, I want to. Okay, yeah. So if I want, no, no, see this. USD is the base currency. Okay. So we have to see what is happening to base. Are we buying base or selling base? So if I want to buy $1 million, what will it be? It will be my bid price, not my ask price. Okay. What you guys are getting confused is with the euro. Don't get confused with the euro. See what's happening to the base currency. So we will use 8912. Okay. Is this clear with everyone? So now how many euros will it be? I think 891 euro, 891,200. Okay, that is how much I will sell. Okay, so if you guys look at this, right, when we talk about FX swap, we said it's a combination of the above deals, right? Cash, term, spot, forward, etc. Okay, now let's say that so we'll take your example of what you read. Okay, so that's also applicable. Okay, now let's say that we entered into this deal and we said it is cash. This USD euro is a cash deal. Okay, so what does that mean? The trade date equals the settlement date. Yeah, same day. Okay, now let's say that now we'll take Saurav's example, okay, of what he's read. Okay, and that's also a correct explanation of what's in the textbook, right? Is that now let's say that so I bought $1 million from you and I sold you 891,000 euros. Okay, but let's say that 5 days from now, okay, now, or let's say 5 days from now, I want to buy the euro back and I want to give you the dollar back. Okay, so what we can do is that we can enter into another USD euro deal, but we can say it's a forward deal. Okay, where basically we'll say trade date plus 5. Okay, so what happens is that since today's trade date, we have the exchange rate confirmed, right, as 0.089. That exchange rate will be the same for both the transactions. Okay, so what ends up happening is that I hedge myself against exchange rate risk, because when we have entered in the contract today, we've locked in the exchange rate at 0.89. Okay, so on the cash deal, we will pay I'll buy 1 million from you and I'll give you 891,000. Now because we've agreed the exchange rate for today for the forward deal, right? So on 5 days from now, or let's say next Friday, what will happen is that I will pay you $1 million back and you will pay me 891,200 back. Okay, so that is an example of a FX swap. Is this clear with everyone? So I'm giving you the textbook example. Okay, is this clear? Right now, if we talk about, let's say, something in what generally happens. Okay, so let's say that we do a USD euro deal and we do another USD GBP deal. Okay, two different currencies. So even in this, right, we can, so USD euro we can do a cash deal, and USD GBP we can do a term deal. Okay, but what's happening is that the exchange rate is as per today's rates. So irrespective of USD euro, I mean whichever the currency we're trading in, right? And when we're settling it, rather what it is that we agree the exchange rate today so that we can take a future delivery. So for example, the USD euro cash deal, I'll pay you USD, you pay me euro today. Now the USD GBP deal, I'll pay you today. No, sorry, USD GBP, we'll agree the exchange rate today, but we'll settle it tomorrow. Okay, or we can even do this, right, is we can do a cash deal and we can do a spot deal. Okay, or we can do the previous example, right, we can do cash plus forward. Okay, or any and the other combinations, right? So we can do this as Tom deal and this as a spot deal, or we can do this as a Tom and a forward, okay, etc. So all those different combinations is your FX swap. Not necessarily Biswajit, because whatever is the current exchange rate in the market, right? That's what you have to agree. Unless there's a bit of negotiation, there might be because it's all OTC. But largely, whatever is the current exchange rate, that's what gets traded. Okay, is it clear with everyone? Okay, take a minute and write this down. Uh, you guys want me to scroll up, or where do you guys want to? I don't know if you guys written everything on FX swap. Others are done. One more minute. Okay. So are we clear with FX swap? Okay. So let me kind of reiterate. Okay. Interest rate swap is used for speculation and hedging purposes. Okay. Actually, when we look at all of the derivatives, right? Like I mentioned before, you're doing both. You're either speculating and or hedging. Okay. So when we talk about CDS, if you own the underlying asset, you are hedging. If you don't, you're a speculator. In FX swap, largely you are speculating on the exchange rates. Okay. So now we'll talk about the next one, which is what we call as equity swaps. Okay, equity swaps. Now, what is an equity swap is it's an OTC derivative contract that exchange cash flows based on the performance of an equity or an index. It's based on the performance of an equity or an index, okay? And one leg of the swap contract has to be an equity or an index, okay? Now, there are various, what do you call it, different types of equity swaps. Okay, one is, let's say, one is equity versus equity, equity versus index, and also index versus index. Okay, is this clear? So we'll work out an example. Okay, but when talk about equity swaps, it's an OTC derivative. You exchange the cash flow based on the performance. So we use the term performance when we talk about equities, right? And the index, we have to see how the company is performing, or how the index is performing. Okay, and once a part of the one leg of the swap contract has to be an equity or an index. Okay, so the different combinations are equity versus equity, equity versus index, index versus index. Okay, all right, take a minute, write this down, and then we'll go through an example. Okay, cool. Let's look at an example. Okay, so we have two hedge funds. Okay, an alpha fund and a beta fund, and both of them. Now, let's say that hedge fund is hedging. Okay, and beta fund is speculating. Okay, so that's also possible. So again, what's the difference between a hedger and a speculator? Hedger owns the asset and the speculator does not own the asset. Okay, now if I have if I'm alpha fund and you're beta fund, um and if I'm saying I'm hedging, right, what have I done? I have invested $1 million in Apple shares. So if I invested $1 million in Apple shares, what am I worried about? What am I worried about if I've invested? Yeah. So fallen share price. So I'm going to be bearish on Apple. Okay. And if you are a speculator, right, what would you be? So here it's not. So see, in the markets, like I explained before, right? When talk about there has to be 2 points of view, right? So if one is bearish, the other one is going to be bullish on Apple. Okay. Is this clear with everyone? So now what happens is that both alpha fund and beta fund will contact an investment bank. Okay, they'll contact an investment bank. Now the investment bank will structure the equity swap. Okay, so how will this look like, right? So alpha fund will pay when there is a positive performance on Apple, and beta fund will pay when there is a negative performance on Apple. Okay, so 2 points of view, two different points of view. Okay, now what does this mean? Okay, let's see. Anybody know the Apple share price? Give me 1 second. Apple share price. Okay, $331. Wow, that's gone up a lot. Okay, yeah, $331. Okay, now let's look at what we mean by this. Okay, now when they enter into the contracts, we'll take the strike price as, again, got to be this thing, $331 50 cents. Okay, that's the strike price. Okay, now 1 year from now, okay, 1 year from now, what will happen to Apple shares? Let's say we do a 3-year contract. Year from now, what can happen to Apple share price? Right, yeah, so it can be either above 331 or it can be below 331. Okay, now let's take an example of let's say 1 year from now, so in 2021, Apple's share price is, let's say, dollar 300. Okay, in year one, the share price of Apple is 300. Now who's going to pay who? Can anybody tell me? Who will pay in this case? Okay, yeah, so here what happens is that beta fund will pay alpha fund. Okay, beta fund will pay alpha fund. Okay, now the next question is, how much will they pay? Anybody want to take a guess? Okay, difference in what? Okay, the price, but how many shares? Do we know the number of shares? so Saurabh, how do you know that they bought those equivalent number of shares? What if they Alpha Fund bought those shares 10 years ago? And 10 years ago, Apple shares was very different from what it is now, right? So you actually cannot. So your thought process is the obvious thought process, but that's not what it is. Okay. Rather, what you have to do is you need to figure out the rate of change. Okay, ROC. Do you guys remember what's the formula for rate of change? I'm guessing no. Okay. So it is new value minus old value divided by what? New value into 100. Okay. Are you guys with me or getting confused? See, Alpha Fund and Beta Fund have entered into an equity swap. Now we don't know the number of shares that they have invested or bought, okay, on Alpha Fund side. So what we rather have to figure out is how much did the price of Apple change from 2020 to 2021? Hang on one second. Wait, 1 second. Okay, sorry, some fell on a terrible bike. Okay, is this clear with everyone? So we don't know how much Alpha Fund has bought. Okay, we don't know anything. So that's why we have to figure out how much did the price change from 2020 to 2021. Because Dipesh, that is the structure of the equity swap. Look what it says. Beta fund will pay when there is a negative performance in Apple. Now look at what has happened. The price is 331. Now, if it goes up, that's a positive performance. If it goes down, it's a negative performance. That is why beta fund is paying alpha fund. Okay. Now, what is your new value here? Your new value is $300. What's your old value? 331.50 divided by 300 into 100. So what will you get? Can anybody do that? Are you guys understanding me? Okay. You will get negative 10.5%. Is it sort of is it new value or old value? Hang on, it's been a while. 1 second. Let me old value. Sure, right? Okay. Sorry. Old value. So this will change to 331.50. Okay, old value. Okay. So 300 minus 331.50, you'll get 31.5 divided by 331.5 into 100. Okay, you will get negative 9.5%. Is this clear with everyone? Guys, there's only two to three of you who are interacting with me. The rest of you, do you guys get this? We are doing simple subtraction, division, multiplication. Yeah? Now, since we figured out 9.5%, now what do we do with this? So we take this negative 9.50% and multiply it by how much? How much should we multiply by? What do you guys think? Good, Shreya. Yeah, exactly. By $1 million. So how much will that be? Okay, that will be USD $95,000. Okay, and this is what Beta Fund will pay Alpha Fund. Is this clear with everyone? Yes, so we're not doing anything extremely difficult here. Okay, now let's quickly look at year 2. So in 2022, let's say the Apple share price is $315. So who's going to pay who? Okay, so in this case, no, what has happened? See guys, your strike price is the day you enter into the contract. Fine. But now, will you ever compare your second year data with year 0? With your strike price? Yeah, no. So what you'll do is you'll always compare it with your previous year. So you'll compare 2022 from 2021. Now what is it? Is that Alpha Fund will have to pay Beta Fund. Okay, now how much will they pay is the question. Is this clear with everyone? So now what do? We figure out the ROC, new value minus old value divided by old value into 100, right? So how does this look? So what's the new value here? 315 minus, what's the old value? 300 divided by 300 into 100. So how much will we get? Okay, Correct. 5%. Yeah, 5%. Now 5% into $1 million. Okay. So how much will Alpha Fund pay? Yeah, will pay USD 50,000 to Beta Fund. Okay. Now understand this, guys. Let me scroll up. When you look at Alpha Fund, right, he's bearish. Okay, now he's expecting the price to go down. Now, if the price goes down, he got his bet right or his speculation right, so he has to get paid. But if he gets it wrong, he has to pay. So it's very easy to understand financial markets. If you get your speculation right, you will receive money. If you get your speculation wrong, you have to pay the money. Okay, is this clear with everyone? Okay, take a minute. Yeah, that's why people love options, true. But options are very, very difficult, and most people fail in options, and that's a good thing because if they fail, that means other people can make money, or specifically, I can make money, right? Oh, yeah, it's very tricky. Okay, so take a minute and write this down quickly, and then actually, that's it for the day. Uh, Yeah, but Shreya, you gotta understand that. Yeah, the price will go up. Okay, that's fine. So when the prices go up, they will earn the profit or they will earn capital appreciation when when the prices go up. That's fine. But what are they worried about? They're worried about prices going down. So they're worried more from a hedging perspective. Why, Dipesh? It's not difficult. Watch the videos again, okay? And next week anyway we have your level 1 refresher, so we'll clarify it. These, by the way, guys, we're not even discuss the mathematics for any of this, okay? Saurav, you can I think some of the stuff you studied, right? And you know how tough the math is, right? So in the math part, right, you actually do a lot of calculus and all of that, okay? So we're just discussing the concept. So you just have to understand the logic of this. Okay. Okay. So quickly write this down, uh, and we're done for the day actually. So if you guys have any doubts that you want to discuss, we can do that. Otherwise, we can call it a day. I'll leave it up to you. So finish writing first, and then we'll see. Sure, Deepesh, I'll do that. Because what happens is once the recording is stopped, right, it takes about 3 4 hours for the conversion to happen. And once the conversion happens, then the file gets created, then only I can upload it. So it takes some time for it to happen. Okay, guys, quick, write this down, and that's it for today. So if you guys have nothing further to discuss, we can wind up, or we can chat for a few minutes. But either way, I will stop your recording for now.